Hey, good evening, everyone. A lot of traders are still coming into the room, so we're going to start in 60 seconds. First, with the mandatory disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures, forex, or stock markets, or for any profits or losses that may be incurred. Participating in trading the forex and futures markets and the stock market involves substantial risk. That should be understood that a person includes a substantial amount of money. Therefore, the participation in these markets is not appropriate for everyone. Careful consideration of your financial position should be made prior to trading. Never risk more than 2% of your account in any trade. Do your own due diligence. And Right Line Trading is not a registered financial advisor and not a licensed commodity trading advisor. Okay, with that said, I'm going to skip up my own introduction here and just move on to the first slide I want to get to. What we're going to talk about first is order flow. Now, 5 or 6 years ago, there was really a big explosion in the way that we can leverage volume in our trading. And I know that everybody is familiar with market profile. And the thing that's happened with market profile is that I think it's sort of fallen by the wayside. And that actually, if you look at market profile mathematically, it never really made any sense to me that it should work. And you don't see really anybody proffering market profile anymore as an instrument to help with your trading. Now there's more emphasis in looking at a volume ladder and looking at volume delta, looking at zones of absorption and things like that as a way to use volume to help with your trading. Now, whether you're trading the forex market or the stock market or the futures market, at each level, whether it's a tick, pip, or a cent, there's a bid-ask disparity. And the bid and ask disparity is how many traders are sitting on the buy side of the dome versus how many traders are sitting on the sell side of the dome. This does not look at executed trades. It's simply looking at market depth on each side. Now, if there are more traders sitting on the buy side, one would think that that would be indicative of buying pressure and that the financial instrument that you're trading is going to rise. Now, you can look at it and hone in on it right down to the cent, pip, or tick level. And each candle that you look at is going to have this bid-ask difference. Now, I personally, in looking at this kind of metric, don't believe that any individual single price value has enough throw weight for you to trade. So what we use is we use a number called the market delta. And the market delta sums up all the traders on the bid versus all the traders on the ask and comes up with the difference. And in this particular case, that's a positive 29.85. And that tells you that there's significantly more buying pressure than there is selling pressure. Now, the problem with market delta, and looking at all volume analytics, is that sometimes the market delta does not predict the appropriate direction that the candle is going to close. Here's a positive 222 on a down candle. And what this relates to is the overall aggressiveness of the sellers versus the aggressiveness of the buyers. Usually they're equally aggressive, so that a positive number is associated with an up candle, a negative number with a down candle. But when the sellers are more aggressive than the buyers, even though there are more traders on the dome on the buy side, the positive delta can be associated with a down candle. And in this particular case, a lot of traders are sitting on the buy side, but they only want to pay a specific price, and they're going to wait around for that to happen. But the sellers are willing to sell, are willing to sell their contracts at whatever price they can get, because they are very aggressive. They believe the market is going to fall. So they're much more aggressive than the buyers. So they step in ahead and are able to push the market to the downside. And that's the problem with the market delta metric, and why when you look at charts like this, they are very misleading. This is what most indicators will show you. They'll show you a series of candles, and you can see most positive deltas are associated with an up candle, up candle, up candle, up candle. And most negative deltas are associated with a down candle. And then what they'll do here is they'll show you a plot of the absolute value of the change in magnitude of the delta. So as the delta becomes more positive to the upside, this line will rise. The problem is that on the right edge of the chart, where you need to determine where price is going to move out into the future, the delta can get more positive, but the candle can still close to the downside. And that's problematic in using the market delta to predict where the market's going to go on the next candle off the right edge of the chart. This rising line does not predict that increased buying pressure is going to actually close the candle to the upside. Now, if you look inside the candle, it shows you here where there's sequential disparities towards the sell side. So sequential sell side disparities. Here's a strong buy side disparity, sell side, buy side. And other systems look for stacked disparities from one candle to the next. The problem again is the same, is that this number does not always predict the direction that the candle is going to close. And if you use this, you're still gonna walk into losers. But the market delta number still is extremely important. It just has to be used appropriately in order to trade with it. So what we've done is determine that one standard deviation's worth of data work. And that when you get a negative delta on an up candle, those are outlying values. So what we need to do is to toss away the outliers and just use one standard deviation's worth of data. And then we can leverage market delta in an appropriate way, and it can give us tremendously powerful predictive value as to where the market is going to move out into the future. And this is how we do it. First of all, we don't, it's really part of our discipline is that we don't look at any data from the trading chart. We almost always assess where the market's going to go based on data off of the two higher time frames that you're trading. It doesn't matter whether you're trading time, tick, range, Renko, Unirenko. The system will look at the two higher multiple time frames. If you're trading a 3-minute, it'll look at a 9-minute and a 27-minute. If you're trading a 5-range chart, it'll look at the 8-range and the 13-range chart. And it does that automatically. So we look at the delta of each candle on the two higher multiple charts. Now, we trade Unirenko, so I put Unirenko here. But it really does not matter what kind of time frames you trade. We're going to be looking at the longer term time frame charts. And then each market delta value is going to be placed into a 15-period simple moving average. So what determines buying or selling pressure is the average of the last 15 market delta values. And that throws the outliers out and just allows us to use that one standard deviation's worth of data. Because out of the 15, probably 11 or 12 deltas are going to close in the appropriate direction. The 3 that don't are not going to appreciably change the slope of the 15-period SMA. And when both 15-period SMAs are sloping up, each of them created by one of the higher time frames we're looking at, then the bulls are firmly in control of the market. And the market delta assessment or order slope, order flow line is going to be green. And when both of the 15-period moving averages are sloping down, then bears are firmly in control. The order flow line is going to be red. And when the 15-period SMAs are not in agreement, it's going to be yellow. And it's very important when you see that yellow line, because that's a great time not to trade, because you don't have an alignment of the two moving averages. Now, here's an example. Now, I'm going to be showing you a lot of examples off of live charts. I have my NinjaTrader up. It's right behind the slides. So we're going to look at how the system performs in real life. But when the order flow line is green, it shows that the bulls are in control. The assessment it's a market delta assessment of the two higher time frames, and price is almost always going to follow order flow. When the market delta moving averages of the two higher time frames are both sloping up, price is going to turn, the line's going to turn green first, and then price is going to rise. And it's the only direction that you can trade. Now, I don't recommend trying to call a top or a bottom. If you do, you're really going to have a lot of problems. And if you've been day trading or swing trading for a while, you see how hard it is to call a top or a bottom. And I don't think it's mathematically possible to do it. What we try to do is get in very early on a trend trade, because when these lines are green, it really is a proxy for the direction of institutional money. It's very hard to create a dual green, both of those moving averages sloping up, unless institutional money is involved. So we're using order flow as a proxy for institutional money flow. Now, if you want to try to call a top, which I don't recommend you do, you can't until order flow changes color. Now, there's going to be, I'll also tell you other reasons why, even though order flow changed color here briefly, you're not going to go short. because we're going to move on to other things that we look at to trade. But we're going to only look to go long. And one of the things that we're going to look to do is take advantage of all the traders that try to counter trend trade. Because when they do, they're almost always going to lose. And when we go back into the market in the appropriate direction and run them over, they're going to help us push the trade in the direction we want it to go. These sellers here, we would be in right on this candle. And as we run these traders over, they've sold their contracts or their stock or their lots. If they're trading the Forex, they're going to have to buy them back to get it out of this trade. And when they do, they're going to help propel the trade to the upside. So we're always going to look to take advantage of traders caught in the counter trend direction. And there are always traders that do. They're trading oscillator divergence, MACD divergence. They're trading Elliott wave, Gann theory, even Fibonacci, none of which I believe works. And I'm going to tell you later why it does not work anymore. But we're in the move in the direction of order flow as a proxy for the direction of institutional money flow. Here's another example. When this line turns green, price is still going to fall potentially for a while. Then it's going to turn. And we're only going to trade long. And every time we get counter trend traders, we're going to try to move back in long again to run them over. Back in long again to run them over. And as they're run over, they're going to help propel the move to the upside. It's something that's rarely talked about, how important it is on an entry to always try to leverage counter trend traders caught in the wrong direction. Because in addition to more shares or lots or contracts being purchased, these counter trend traders really help a lot in guaranteeing the continuation of the trade in the direction of the trend. Here's just one more example. You can see that it leads price. I'll show you that on a live chart. The order flow line turns green, price starts up, and then just doesn't turn until this line turns. It changes color. Remember, price is not, this line is not green because price is rising. Like most indicators on most charts of the software that you purchase simply uses the data from your trading chart. So when price rises, this is going to go green. If it was a MACD, you get a MACD crossover. This was an oscillator, you get an oscillator crossover and a signal to go long. This line, price is rising because this line is generated from data supplied to it by the two higher time frames. When it goes yellow, it defines chop, and when it goes red, we look for the market to fall, and it almost always does. And when it goes green, up. Now, when it keeps changing color, now right now when it's only one line, it's impossible to tell when it's going to do this, but you can see retrospectively that it helps us tremendously to define chop. Anything taken here is going to be a potentially very high risk trade because order flow keeps changing direction. This shows lack of any institutional participation. All we're seeing here are the commercial traders, jerking the market up, then jerking it down, pushing it in different directions. But the problem with right here is that the market lacks any definitive trend. Once institutional money goes to work, you can see that the order flow line turns green and price rises. And I've always asked traders when I do my mentorships, what's the most important thing that you need to do when you swing trade or day trade? And I almost always get the answer is to get winners. But that answer actually is wrong. You're always going to be able to get winners when you trade. And that 95% of traders that bust out of the market do so despite the fact that they get multiple winners every single day. The problem is avoiding losers. And that's what this system helps to do. By strictly defining chop, you get to stand aside in a market situation that is in chop and allows you not to take a trade. We want to take low risk, potentially high reward trades. Never step into a market when the risk for getting a winner is high. We want to avoid losers at all costs. That's our number one goal. And if we do, we are going to be very, very successful traders. No matter what your goal is, it doesn't take a lot of winners every week for you to make it there, as long as you can avoid taking losers. Now I'm going to close this deck, and I'm going to move to another one. If I can find it, it's right here. And here we're going to talk a little bit about the oscillator. Now, the oscillator, I think, is one of the most misunderstood indicators out there. If you look at YouTube, you'll find that there's not much information out there about exactly how to trade it and exactly how to use it to make money. And just a little bit of background on the indicator. Now, it was created by George Lane in 1957. And George Lane was a really brilliant mathematician, and it was really one of the earliest indicators ever created. Now, George Lane created the oscillator, and what he did create was the stochastic oscillator. Later, we got relative strength, we got Williams percent K, we have an ADR/ADX oscillator, we got different oscillators. But George Lane created the first stochastic. And his rule was that he never used it to track the movement of the trend. He used it solely as a method of looking for reversals. He used it as a divergence tool. He was solely looking to fade the market every single time he traded. Now, just backtracking for a second, what does the oscillator look at? And what it looks at is momentum. And his feeling as a mathematician was that because momentum was a second order derivation, that it would lead price on its own. And to give you an example of that, if you have like a racing car going around the track, if it's going at 100 miles an hour constantly, momentum is constant. If it then begins to accelerate, momentum begins to rise. So essentially, momentum is an assessment of the rate of change of speed of that car. If the car begins to decelerate faster and faster and faster, it begins to brake harder and harder and harder, then momentum begins to decrease faster and faster and faster. And momentum will start to fall to the downside. And he believed because this was a rate of change in speed, or a second order derivation, it would lead price. And let me give you some examples. First, I just want to show you really quickly the basic formula of an oscillator. And it's important to understand it because I think it gives you more insight into how the indicator works and how it traces out that percent K line. And it's really a very, very simple formula. C here is the most recent closing price. And then it creates two moving averages. An L14, which is the average low of the 14 previous trading sessions or candles, and an H14, or the average high price of the last 14 candles or last 14 trading sessions. So it's got an average low price and an average high price, an L14 and an H14, and it compares the close to these two moving averages. And as the C, or the close, approaches that average high, candle after candle, momentum is going to the upside. So when price is approaching the high of the move, momentum is rising to the upside on a long move. On a short move, when the close of the candle is approaching the low, then momentum is accelerating to the downside. And that's how you get your percent K line. And the percent D line is just a 3-period moving average of the percent K line. We're not going to be concerned about that. Now, back in the day when George Lane was trading, I believe that his thesis was correct. Now, I want to review what he was looking for and why I believed it worked. And then I'm going to tell you why it doesn't work anymore and why there's a lot of things that worked back in the 1950s and 60s and 70s and 80s and 90s that just don't work anymore. And again, we'll discuss the reason why the way we trade now has to be significantly different than the way traders used indicators and traded the market way back in those days. Now, first of all, just let me get a quick drink here. If we look at this move up here, right to here, or up to here, what this is measuring is the speed that price moves up to this point. It creates this much upward momentum. Then it falls, it accelerates up to the same price here, but it does it with less momentum. So it accelerated up here quickly. I mean, it built price, and like that race car, it accelerated up to here, came down, but when it accelerated up to here, it did so with less speed, with less energy. And so that second top here created divergence. Now, it tried to make the same high a third time, but again, it accelerated up to this price with lower momentum. And what that did was it signaled to us the price was going to collapse. So when we start to see momentum collapse or momentum fall, but price making an equal high or a higher high, but propelled up there on a decreasing amount of momentum, back then we could assume the price was about to bottom out on a long move. And I just created a different kind of divergence scenario. Here we get price accelerating up to this point here on this much momentum. Here, price makes a higher high. It accelerates up to here, but it does it on the same amount of momentum. When price makes a higher high, we want it to accelerate up to that high faster than it accelerated up to this high. So this creates momentum divergence. And you can see that there was a collapse in price. There was a subsequent collapse in price. Now, back in the day, if you look at the oscillator, we'll just move right over to here. And I just took this off the internet. This is an old slide, and I purposely wanted to grab an old slide. Obviously, it's not back in the 60s or 70s or 80s, but it's back at a time when if the stochastic line crossed the 20 line to the upside, we got an up arrow, and we went long, and it was likely to be successful. If the stochastic line, and this is the percent K line, crossed to the downside across the 80 line, we had a signal to go short. This one doesn't work, but this one does, and it's extremely successful. This move of the percent K line above the 20 line is very successful to the upside. So now George Lane didn't trade it this way. He just traded momentum divergence or stochastic divergence. But you could also use the tool as an overbought, oversold tool to call a top or to call a bottom. And I think, going back 10 years, that was possible. Even going back 15 years, that was possible. But it's not possible anymore. Now, here's the reason why. If you look at this slide, and I don't know anything about this company, China Lending Corp. I just liked the way the slide was portrayed to provide an example of what is going on now in the market. And that is that the market can stay overbought for, I don't want to say forever, but essentially for a very long period of time. I mean, the market right now has been overbought on, depending upon the time frame you're looking at, for days, weeks, or months. So even though the oscillator moves into overbought territory, and it can do so with divergence, it doesn't matter. The market is going to get to continue to rise. And divergence as a signal no longer works. Multiple divergent signals are going to fail. Now, occasionally, it's going to work. I mean, it is operational and it does have validity. But when a signal works sometimes and doesn't work other times, and you can't determine when it's likely to be successful or likely to be unsuccessful, to stand aside, it's a useless way of trying to trade the market. And the reason that overbought doesn't always mean overbought anymore, based on this mathematical analysis, is because of institutional money. Going back 10 or 15 years, commercial traders ruled the market, not institutional traders. Now it's completely different, and it's only going to get worse. Institutional volume is going to comprise a greater overall percentage of the total volume of most markets to a greater and greater extent as we continue to move out into the future. And this stochastic indicator is not going to work as long as institutional money is still pushing this instrument up to the top. I mean, if you day trade the NASDAQ or crude oil, you know The crude can go up 50 or 60 ticks, and it can be an overbought territory. It's irrelevant. As long as the institutional traders continue to press, continue to buy shares or lots or contracts, that financial instrument is going to continue to rise. And no mathematical computation that we can make is ever going to tell us when the market's going to turn. And every counter trend trader that steps in and tries to call a top is simply going to get really run over. Now, what has this done to the market overall? Now, if the market as a closed system had an intrinsic waveform to it, like Elliott wave, that Elliott wave is obliterated. If it had a particular type of symmetry as a closed system, as predicted in Gann theory, that intrinsic pattern is obliterated. And if you look at Japanese candlestick patterns, they're important, and I have studied them extensively, and I like to look at them. But all of these systems are predicated on the following. And this is something you've probably not heard before, but it is something that is 100% true. Is that all of these systems are predicated on the following principle: that the power of each buyer is approximately equal to the power of each seller. And that was true in the market for 50 or 60 years, going all the actually, you can say for the last 400 years, if you go back to when the Japanese rice traders created Japanese candlestick patterns, but it is no longer true today. The power of each buyer does not equal the power of each seller. So that means the only thing that we can do to trade the trade the market profitably is to track the direction of institutional money and go with it. If we try to counter trend trade or trade in a market that lacks the participation of institutional money, we're likely to get stopped out. Now, I've created a couple of rules that I use, and I believe it's how you need to trade the market today. Now, there's a lot of software out there that tells you they can call a top or call a bottom, and that is absolute nonsense. I know a lot of software packages that will charge you an arm and a leg to do it, but it's not possible. There's no such thing as overbought or oversold. This is a fallacy. There's no mathematical way to determine when institutional traders are going to stop buying the E-mini, for instance. I mean, I've been listening to talking heads on CNBC and on Fox News for months calling a market top on the E-mini. And the E-mini is just continuing to rise and go higher and higher and higher. That's because the institutional traders are not finished with it yet. And until they are, it's going to go up. And there's no fancy formula that's going to tell you when they're going to step aside. And so markets are going to reverse only at the direction or only at the whim of institutional money. When institutional traders believe that the market's gone as far as they want it to, it's going to fall. We don't know when that's going to be, but that's the top, and we can't call it. Now, the mathematical principle that still does hold true is that when institutional traders step aside, the price will quickly try to revert to the mean. I mean, price always has a pull on it to try to get back to mean price. And the farther out it's pushed away from the mean, the faster it'll snap back. And that's what the counter trend traders are looking for. I mean, they're looking to get in at the beginning of a counter trend move, because usually if they can do it, and now that it'll snap back to the mean fairly strongly and rapidly if it's been pulled way off the mean. And the mean can be your 50 period moving average, your 100 period moving average. The longer the moving average, the more power that mean price has, the more power it has in pulling price back to it. Once institutional traders are done banging it to the upside or to the downside. So trading divergence is tantamount, excuse me, one second. So trading institutional money is tantamount to trading against institutional money. And you don't want to do that. I don't want to do that. We want to trade with them. And we can only trade in the direction of money flow or institutional money. So what indicator most accurately assesses buying and selling pressure, completely ignoring any potential divergence? That's the kind of oscillator we want to use. And it turns out that it's the Laguerre oscillator. We want to use momentum as a metric that helps us trade because it really has tremendous validity. We simply have to use a tool that assesses it correctly and always stay and trade in the direction of momentum, not try to anticipate when momentum is going to turn. And the Laguerre is a very different kind of oscillator. It has a default gamma of 0.5. It's got multiple filters to determine the speed of the %K line. All of these we've reset and changed to give us a %K line that moves fast but also has stability. And it tracks the direction of momentum and never looks for divergence, because we don't want to ever trade divergence again. And here's an example of what we look for and how we assess it. Now, we use a multi-time frame assessment, but on this chart, I'm only showing you the Laguerre on our trading chart because we look at that too. Now, this arrow, this little green arrow here, you're going to get on your chart, and it's going to print intra-candle to tell you that if the candle closes to the upside, you're going to get an entry. It's when our Laguerre line crosses across the 20 line to the upside. And then what we do is we look for momentum to continue up and then lock long. Now, back in the old days, this lock long here, represented by this green line, would trigger traders to look for divergence to fade the market. What we do is we know that institutional money has pushed momentum. This is a bounded indicator up to 100. And we're going to ride this momentum long, knowing we can never tell when it's going to turn, but that as long as it stays locked long, we're going to continue to get a rise in price. Now, you can exit on this down arrow, which is a cross of the Laguerre across the 80 line down, or you can enter on a break of support. But the principle being, we're going to ride the direction of momentum to the upside, never looking for divergence. And Laguerre is the best tool to do it. Now, here's another example, and a better example. Here's the arrow with the Laguerre cross from the 80 line down. And here's where it locks short. And price just continues to fall, as long as momentum is locked short by institutional traders. Now, this is a 60-minute of the Qs. The other was a 30-minute of the Qs. This is a universal force that is active on any market and on any time frame. Does not matter what you trade. You can trade stocks, you can trade futures, you can trade Forex, you can trade it on any time frame and on any kind of candle. It's irrelevant. When institutional traders lock this down, you're going to want to stay short, never looking for divergence, and just ride it down as institutional money pushes the trade to the downside. Anybody in here who's trying to counter trend trade, and there are plenty of traders who are going to get stopped out. And here's a daily. There's the cross of the 20 of the Laguerre line above the 20 line, and it eventually locks long, and up we go. We don't want to counter trend trade. These are where we get our best trades. Now, this is the futures market, and here's a cross across the 80 line at the arrow, and then as price moves down, the Laguerre line locks short, and we can ride that short Laguerre lock all the way down, exit on the up arrow. Same thing happens here. We get the arrow, 80 cross, it locks short, 80 cross, it locks short, and we can exit on the arrow. Now, I want to show you the difference between the Laguerre and between stochastic. And I have a slide where I show you the difference between the Laguerre and relative strength, and the Laguerre and Williams percent K. They're all the same because those indicators were created to track divergence. And our indicator is tooled to follow the direction of momentum and not track divergence. So here's the entry based on stochastic. Here's a cross of the percent K line of this with the signal line, right below the 80 line or the overbought line. Our entry, which is right here on this arrow, which prints on your chart. You're going to see it flicker intra-candle, so you can get your sell stop order in one tick below the close. And then as the move goes to the downside, here's what you're going to see. If you have stochastic right here on these two candles up, it's going to push that percent K line above the 20 line, and you're going to exit because that's your ticket to exit the trade. Momentum has shifted direction according to stochastic, and you got to get out of the trade. But if you look at the Laguerre line never crosses the 20 line. It stays locked down. So while you're exiting the trade here based on your stochastic indicator, your Laguerre is locking short, and you get the entire trade. So the purpose of our indicator is completely different than the purpose of all the other oscillators. It makes an immense difference because you're not going to get shaken out by one or two sets of traders trying to call a bottom or a top. In fact, we welcome these traders. This group of traders calling this market as a market bottom is followed by the short candle. Again, traders are calling a bottom and they're going long. There come the shorts to run them over, and they're propelled down by stopping out everyone in these two long candles. You get a long candle here and a long candle here, and these traders help push this move to the downside. As they get stopped out, they have to sell their contracts. So we welcome these small counter trend moves because the Laguerre won't get faked out by them. It'll keep us locked long. Short. Now, once in a blue moon, they'll call a bottom, but 9 out of 10 times they're going to call it wrong, and we're going to be in the market in the appropriate direction. And this goes into more of the types of trades we take. I'm going to do that on a live chart. So let me going to exit the slides for now. I'm going to drop these charts, and let me create really quickly a template for our gear order flow. And this is how easy it is for you to create it. Just going to create a new chart right here. This is, I picked crude oil because it's got a lot of volatility. But later on, we can look at anything that you like. And we're just going to put in our gear, and here's our template. Now, let me show you exactly what you're looking at, because if you're looking at this for the first time, it's going to look confusing. First of all, line number 1 is order flow. And the order flow data is projected onto the candle halo. And remember, I told you it was a leading indicator. You see how this moved down here? This last down candle has up order flow. You can see the candle is highlighted or surrounded in blue. And then the market turns. The move to the downside, the last candle is highlighted in blue. Order flow turned first before price. Up you go. If you were going to trade short here, you can't. Order flow is aligned to the upside. You can only take the trade up. When you get to the top, order flow turns first. This is an up candle with down order flow. Look at the color of the candle halo. It's magenta, and price falls. So you almost always get the heads up on a move, because order flow leads price, and it's going to tell you when price is going to turn, oftentimes before it does. And in order to make it easier to read, since you've got a lot of lines down here, we've projected this line, this top line result, which is our order flow line, off of the 2 higher time frames onto the candle body. Now, if you look at the indicator right here, I have just elected to make the down order flow magenta and the up order flow candle halo royal blue. You can make these 2 colors anything you want. If you want down order flow to be red, you can change it to red. If you want it to be yellow, you can change it to yellow. You can also change the thickness. Now, since we have the data on the candle body, what we're going to do is we're going to eliminate the line. We don't need to see it. So we take the line, we make it transparent, and we make the chart a lot simpler to read, because now we only have 2 lines below us, and we have the candle halos, and that's all that matters. Now, the upper line is the long-term Laguerre assessment. It is our critical line. We do a multi-time frame assessment, just like we do for order flow. And if I can get it to trace out in here, I should be able to. This line, can't stretch it out. Well, I think you can see which it is. It's right here. Tells you the direction of momentum on a multi-time frame basis off the 2 higher time frames. And you can see, as long as that long-term assessment of momentum is green, price is going to rise. It's really the pivot around which we look at everything. this long-term Laguerre line. If we look over here, there's our long-term Laguerre line. If we look here, here's our long-term Laguerre line. It's called our MTF modified Laguerre, multi-time frame modified Laguerre signal. And that is really key. And you see here, it's green, but price falls. It's not always going to correctly be able to determine the direction of price. Order flow calls the short trade. I'm sorry, order flow is calling the trade correctly. Our chart Laguerre is, but our long-term isn't. And this is where we just don't trade. We're not going to pick up every winner, but what we're going to do is be able to avoid almost all losers. So let me just go back a few more days and let me load 10 days. And we can get a little bit of a feel for the types of trades that we can take. Now, there are two other things that I always forget to talk about, and I want to mention them now. The other one is the pivot. Our pivot indicator is different than any other pivot indicator out there, and it makes it a tremendous difference in how you trade. Most pivot indicators create the pivot in the wrong place. This is the bonus that we're going to give. A pivot, in most cases, is traced out by most software off the wick low here. But if you look at if you look at Japanese candlestick dogma, a pivot should be created off a candle body low, not a wick low. This is a wrong place to trace it. The reason that most indicators create the pivot here is simply because it's easy to do. It takes very little coding, it's simple, and once they sell it to you, they don't care how it works. You have to take the pivot indicator, or the pivot has to be created off the candle body low. And if you see how terrific it works, right on this short trade here, price bounces. Price comes right to the pivot and it bounces. Price comes down to the pivot and it bounces. It comes down to the pivot and it bounces. And then finally it breaks it here. Now that's another thing that's unique about the pivot indicator. One breach, a one tick pip or cent breach of a pivot does not break the pivot. All these buyers are still here. You have to break the pivot by a 2/3 candle body close. This candle breaks the pivot. And if you look at the way the pivot indicator is tracing, you still have the pivot here. You still have the pivot here, even though 1/3 of the candle body closed below it. Here is where you break the pivot, and here is where you can potentially take a trade that's going to stop out all the buyers in this pivot. So it's a very unique pivot. It's difficult to code, and what we're putting into the package. We never trade into a pivot. What we do is we look to trade, I call it trading around a pivot. Price comes down, it bounces, it bounces, it bounces, and then it breaks it, and we trade the break because we know once we break the pivot, we're going to stop out all the buyers in the pivot and carry them down with us, and the trade is going to move down with a lot of conviction. So let's just look at a potential trade. Now, there's 3 types of trades. This is trade, I call this trade number 3, and it's the pivot breaker right here. The candle that breaks the pivot is always a potential entry. you need to have three things, even though this is a number 3 entry. One, if it's short, you have to have the candle haloed in magenta or your down order flow assessment. It has it. Number 2, you must have your long-term Laguerre. It has it. Number 3, you must have your chart Laguerre either locked red or moving down in the direction of the trade. You can see right here, momentum on the chart Laguerre is just really pushing down hard. We've got everything we need. Here's our entry, and here's how we're going to do. Now, trade number 2 is the continuation trade. Now we get an up candle here, but the up candle has down order flow. You can see it's still haloed in magenta. What's the likelihood that that's going to make it? Well, it's always possible, but I certainly wouldn't want to be in that long candle. I can tell you that. Well, that's an alarm on my other charts. Let me close my other charts. Hang on. Let me close these. Well, that might have been the one because I don't hear it anymore. So what we're going to do is we're going to take the continuation trade right here. Got everything that we want. Now, we would have been taken out of this trade because our trailing stop takes us out on a reversal candle. If your automatic trade management strategy allows you to take more risk on the trade, you could potentially take this whole thing down. We exit on a reversal candle. So you're going to go in on the continuation trade, stop all the traders trying to call a bottom here. Now you've got both Laguerres locked short, which is even better actually than just having your chart Laguerre heading down, although that's still a trade. And you've got the candle body haloed in magenta, order flows aligned to the downside, and down you go. And you got a terrific trade. What's important about this trade is that the entries are exceedingly low risk. The likelihood of them blowing up on you are exceedingly low. That's the key. Now we can look at a whole bunch of them. I mean, we can look at these, but it's pretty much the same setup. Here's trade number 3. Now we don't have any trades here. You see the long-term Laguerre is yellow. When that's yellow, we just don't trade. So if we go back to here, I mean, these trade here here's the same trade. It's a number 2. It's a retracement. Instead of getting a reversal, we just get a wick. And we're in and down. Here we can't trade. I'm sorry, we can't trade because we don't have the momentum on our chart in our direction. Same thing here with no trade. We just have this one trade here. Now here you can see how important the pivot is. Price comes up and hits it, back, hits it, back, hits it, back, next day hits it, and turns price. Never breaks any potential long trade. We don't have one because the long-term Laguerre is yellow. But if we did, we would not be able, we would not trade it. And here's our juiciest trade right here. Now this is a number 1 trade. It comes on the Laguerre arrow. The Laguerre arrow is when it first crosses from the 20 line up. This is our chart Laguerre giving us this arrow. And it tells us that the chart Laguerre has now turned into the direction of the long-term Laguerre, which I told you was the fulcrum around which we use the system to trade. The candle is haloed in blue, and up you go. It's an incredible #1 trade. Now let me show you how important this system is. This is a potential #2 continuation trade. And look at the halo. It's down order flow. It censors the trade. So this potential loss can't take it. So you have to step aside on this trade. It goes nowhere. And you're able to sidestep a loser. Now here, you can't take this trade long, but you can take it long here. And up you go. So you're going to see it's going to censor a lot of losers. Here is all down order flow. Can't take any of these trades to the upside. And here's your take trades. Here's your #3, break of the pivot. Here's your continuation trade, down. And the great thing about this is you see how this candle is haloed in in down order flow, even though it's an up candle, and you've got both gears locked short. This is going to go down for you. Here's the break of the pivot. This one is really not a good trade. You don't have this gear on your chart clearly heading to the downside. So you don't have any trades. We've got this trade and we've got this trade. So I could do this on and on and on. What I'm going to do, I'm going to go to the offer. Here's another terrific trade. Look at this trade right here. There's the wick for the pullback, the whole move. Long-term gear is the key. Right here, this top line. The chart gear is heading down hard, and the candle halo is magenta. Now, I could show you the NASDAQ. I can show you anything you want. If I hid crude up here and it did not let you see the instrument that we were trading, it would trade exactly the same. If I change the time frame or change the type of candle, it would still trade exactly the same. Again, this is time frame independent and it's instrument independent. Order flow and momentum are universal forces that move price out into the future. And if you're simply patient and you're willing to let trades that go on to win, just step aside, you're going to be able to step aside on 1 ton of losers. And that's how you really, really do make money. The pivot indicator is of tremendous value. You have no idea how many trades it's going to save you, because when you trade into an intact pivot, it's very likely to bounce. The only other rule that we employ is that we only go short below the 50 and long above the 50. I believe that the bulls are in control here. The bears are in control here. Optimally, you want the 50 red and the 15 red on a short, and the 50 green and the 15 green on a long. And these are proprietary moving averages, which is also part of the system. This is a 50 EMA of a 50 EMA. This is a 15 EMA of a 15 EMA. This provides you with the speed of an EMA and the stability of an SMA. I don't want to run too much overtime, but if I overlaid a 15 period EMA on this, you would see how much better this line is. I will. I'll do it really quickly and show you. My ninja's getting twitchy here. All right, there we go. I'll just bring the EMA down real quickly. Set at 15. Hit it, and you can see that you see on this move up here how much this jockeyed up the 15 EMA and how much more stable our EMA was. It came up a bit, but it didn't come up nearly as much. It has much more stability, but just as much speed. On the move down, it hugged the 15 EMA. But on this move up, this small counter trend move, the EMA got jockeyed up. Our EMA, the 15 of the 15, stayed much more stable. So it's a much better tool for tracking the trend, momentum, support, and resistance. So let me just take that off the chart. Now let me show our offer. And then I'll answer any questions that you have. It's right here. The system's normally $19.99. We're offering it for $699. For a lifetime license. That's for 2 computers. If you have a laptop and you have a desktop, you get free upgrades for life. If we make this system better, you get that upgrade for nothing. And let me tell you, we've been upgrading people. I've had people with me for 5 years, and they've been getting upgrades for the past 60 months, and we never charge you for that. You get 1 month in the live trading room with me. I'll be trading tomorrow morning at 25 after 9 using this system. You get a 10 module educational training session, and you're going to get 450 videos in the video tutorial library. Now, the first 10 orders will get the pivot indicator. Normally, we charge a lot for it as a standalone because we've done so much coding to get it to work perfectly. And the offer expires on Tuesday, May 7th, 2 days from now. Now, our number has changed. I don't know why I haven't changed on the slide, and that'll answer any questions. Our number is 786, same area code, and I forgot to change it. It's 732-4656. That's 732-4656. If you want to call tonight, Rory is on the phone, has our phone, and he'll answer any questions that you have. 786-732-4656. And let me answer any questions that you have. Hang on 1 second here. Let me just drag the question box over. Okay. Okay. All right. I don't have no questions. So, okay. Well, listen, everyone. Thanks so much for giving me your time. If you want to give us a call, and okay, here they're coming now. Okay, Oli. Can you use the alerts to iPhone? No, they don't go to the iPhone, Ollie. I'm sorry. They're not iPhone enabled signals. You heard the doorbell, those doorbells ringing. The system is alarmed, but you're not going to get it on your phone. It works great on the E-mini. I didn't use the E-mini, just hang on 1 second, Ernest. What ROI have you been seeing for the last 2 years? Rick, we've been trading since 2013, and we've been averaging about $40,000 a year on 2 contracts. 57,000 in 2014, about 50,000 in 2015, about 40,000. I have it's all on the website, but our return on investment has been awesome. As the years have passed, the market's become tougher to trade. But I can show you something. Hang on 1 second. If you just give me 1 minute here. go to something really quickly. And let's go back here. Give me 1 sec. It's here. Hold on. All right. Okay, if we just look, I don't want to overwhelm you with too much data, but if here's the data for our performance the last 2 weeks in April, just the most recent 2 weeks. We made $3,015. This is right off the back end. I can't fudge any of this. We've got 76.56% of our trades as winners. Now, these are all the individual trades taken, all of them. So going back 2 weeks, this is our performance. And if I go back to summary, I've got it right here. That's really nice money for 2 weeks. And that's a 100% accurate figure. 100%. It's coming right off of my back end. So our ROI is good. You just have to be conservative and be patient. The best time frame for Forex, let me just make sure that I'm pronouncing your name right. I'm just going to use your last name, Farrow. For Forex, we configure the whole system for you. I don't know the profit to loss on that, Rick. I can go back to it later and show it to you really quickly. Let's see here. We made 65.85 and the loss was 35.70. Profit factor here was 1.84. We're going to set the whole system up for you. So we're going to set it up on the Forex for you. We're going to put in all of our best settings based upon the kind of chart that you trade, whether you trade time, tick, Renko, range. We're going to also give you our ATM settings, which are our automatic trade management settings. We're going to give you our recommended first, second, and third targets. So we're going to configure the whole system for you, so you don't have to worry about that. They are NTA compliant, Ernest. The system looks beautiful on NT8. There is a recording, Ernest. You know what, Scott? I can give, if you want names or numbers, we can give them to you. I can't give them to you out over the mic because I have to call. We have 150 traders in our training room, and we have so many. The pivots are included, Rick, for the first 10 purchases. We are including the pivots in the 699. Yes, you can see right there. First 10 orders get the pivot indicator. Okay. I just want you to know, I could send you, let me tell you something. There's a lot of traders in our trading room that are far better traders than me. It's humbling, but they make much more money than I do. They make upwards, some of them of 1,000 a day. Now, I purposely only trade 2 contracts because I want to keep it small because a lot of traders in the room have a small account. I could trade 4 contracts or 6 contracts, and that number would be a lot more impressive. The 3,000 could be 4, 5, or 6,000 in profit. Except I don't want to do that. I want to keep it small because I want to keep it at a level where 99% of the traders can do exactly what I do. So I have other traders in the room that trade much bigger numbers than I do and make much more money. Okay, so that's it. I hope to see you in the room tomorrow morning. We make money, I would say, 8 to 10 out of each trading session. And we trade the NASDAQ and we trade crude. Now the E-mini, I'll just show you real quickly for the traders, for the one trader that asked, because it's such a wonderful market. I mean, many times I've thought about trading it instead of the NASDAQ, but the E-mini is just a fabulous market to trade. Just let it load and pray it doesn't collapse. And you have to change some settings, which is what we would change for you. The inputs of 428 here. And we will provide you with templates, so you don't have to make these changes. The long-term input goes from a 13 to an 8. This is an instrument that has less volatility. So the input value here gets smaller, and we can look at the E-mini and take a look how it did on any given day. Let's take a look at it. We'll take a look at it on Thursday, just for the heck of it, and we'll do the whole day really quickly. Here's the open, about right here, and here's your first trade. Right here, actually, here's your second trade. Here's your first on your pullback and continuation. It's a great trade. It's not a home run. It's not a monster. I'll just scale it for you to get an idea of how much money or how far it went. This trade went 1 3/4 points. I'm telling you, this is a gimme trade. Order flow, blue, up. Order flow, blue, up. 15 green, 50 green. Both the gears lock long, and there's the move. Now, that's not to say you're going to get the whole move, but this is where you're going to enter. 1 tick above. Maximum excursion on the trade is 5.5 points. Now, you're not going to take a continuation because we consider the market overbought, just based on logistics. If you get a 5 or 6 point move, you're not going to take another trade long because the market's overextended. Remember the one principle, I'm not making this up as I go along, the further off the 50 you move, the stronger that pull on this reversion back to the mean you get. We like to trade with the 15 tight to the 50, and we can see that. On the short trade, we don't have anything. And right here, we just don't get this trade. It's unfortunate, but I told you they're going to be short. They're going to be winners you can't get. The long-term gear is not turned. We can't trade without it. So there's no trade. And here's our next trade, right here on the break of the pivot, which is right here. The long-term gear is turned right there, and the slope of our chart gear is just rolling down, and you get this big move. Now, the thing about being a successful day trader is never care about the winners that you can't get. Only care about the losers you sidestep. That's a 9.25 point move. Now, if you look here, you go up, head down to the pivot, and bounce. Go up, head down to the pivot, and bounce. Up, down, we trade around the pivot, and down we go for 9.75 points. Perfect trade. Can't trade here. No break of the pivot. And when the pivot does break, it's on blue order flow. And the blue order flow saves a loser, and the market goes up. That's how great order flow is. That's an entry. We have our gear. We have our chart gear heading down. There's the break of the pivot, and order flow is blue. So instead of taking a loser, we sidestep the loser. This is why it becomes so much easier to make money. I want to say it's easy to make money, but it becomes a lot easier. And here is we're just not in, here's where we got to trade, right here. There's our pullback wick. There's our dually gear lock with order flow and up. Now, this is 3, 4 beautiful trades, 1 3/4, 5.5. Unfortunately, we just didn't get this trade, just the way it is. We escaped anything here. Took this pivot breaker for almost 10 points. Pull back in continuation here. I'm not going to bother to scale it. And there's your number one. Well, you don't have the number one because you don't have your long term. There's the problem with the pivot. Into it, bounce. Into it, bounce. No trade. Look at the long-term gear. Nothing. And here on the short trade, you just don't get a wick. Can't get in. Here on the pullback, don't have order flow. Here, you have the pivot and no order flow. And here, you're not going to take anything under this pivot. And now that's the end of the session. So for the entire day, you have, these are the trades. There's nothing else we could trade. I'm telling you, there were no losers. It's 3.5, 9 3/4, huge move we can't get. We don't care. 550 and 1 3/4. I mean, that's the E-mini. It trades terrific. It's really unfortunate that the long term did not turn, but if it doesn't turn, you don't trade. Because when you're on the right edge of the chart, you don't know that the candle's not going to come and go right up against you. So we just have to step aside on the trade. There's no way. See that little wick? Could have traded it, but the long term still hadn't turned. Just didn't turn till late. That's just the way it is. But it trades with that kind of precision. Now, if you can pull 4 winners out of the chart every day like this, you're gonna be in good shape. Let me keep going. That's just for the morning, Scott. I trade from 9:30, from the open. So, until we hit our profit target. Our profit target for the day on 2 contracts is between $400 and $500. 400 and 500. Now, sometimes, and I also have a 3 win and out rule. Because if you can make even 350 in one day, our goal is 1,000 a week after commissions on 2 contracts. So if we can pull in, say, $1,400 or $1,500 a week before contract, before commissions, and you can make $4,000 a month on 2 contracts, that's a tremendous achievement. And that's all I'm looking to do in the room on 2. If I traded 3 or 4 or 5, I would take this number up. But it's only on 2 contracts. It's not a lot. I mean, it's hard to make an enormous amount of money on a trade when you're only trading 2. Remember, the Nasdaq's only $5 a tick. So the way you can do it on 12, not last week, but the week before, I took 13 trades for the whole week. 12 were winners and I had 1 loser. And we had a great profit week. If I pulled it out, you would see it. That's the way to trade. You try to take 15 or less trades in the week. One of the biggest problems that day traders have is they overtrade, and they can't. They just are mouse. They have a mouse heavy finger, and they keep pressing and pressing, and they have 10, 12, 15 trades a day. We want to take 3 or 4 or 5 max, get out with nice profit, and just be consistent. If one day we make 125, we'll take it. One day we make 500 or 600, we'll take it. One day we lose 100, we'll take it. All that matters is how we do over the course of the entire week and ultimately over the course of the entire month. Let me keep going here. Rick, I recommend Ninja if you're good, because we have an in with Ninja, and they'll give you really good. They'll give you better commissions than the average trader. We have one guy we work with. He's a broker. We know what commissions you're going to get. You're going to get stellar round trip on numbers. It's really going to give you low commission because we send them a lot of customers. And Ninja's a good broker. They're really good. Data, your broker will provide it, Farrow. But if you want to buy it, if you look at my Ninja, I always have a dual data feed because I'm always concerned that one's going to punk out on me and I don't want to lose the session. So I only have Continuum up now. But I also have, if I want to, I can connect to Kinetic. Oh, it blew up. I don't know why, but I have Kinetic and I have Continuum. I pay nothing for the Continuum because the broker provides that for free. And if you want to just trade it on a demo to start, we can get you a 2-week data feed for nothing. So the data feed is really minimal. If you're on Thinkorswim, we can use your Thinkorswim data feed to power for nothing too. Those are the potential data feeds. And there's also other brokers that have an API we can use. Even if you use that broker for your stocks and options, we can pull it across for you and power your NinjaTrader on it. So we have multiple options for data feeds. So listen, everyone, have a really great afternoon or evening now. Have a nice Sunday, get a lot of good rest. Let's hit the market Monday. And I really feel like, you want to, it's one of the few things you can think about. You want to twist the head off of it because we're just fighting other small commercial traders. We want to trade with the big institutions. We try to trade against them, they're going to kill us and they're going to bankrupt us. We have to stay away from being those wacky counter trend people and stay in the direction of the multi-time frame trend, the multi-time frame Laguerre, the multi-time frame order flow assessment. And that's going to put us in the direction of big money. And in that direction, it's the only way to make money. Only way. Thank you so much, Ernest. I really appreciate it. And Scott, let me just get your answer to that. The 2-week data that you provided, was that for the combination? That's the combination NQ and crude, not the S&P 500, Scott. I don't trade the E-mini in the room. And let me tell you, sometimes I really regret it. It's a toss up between the NQ and the E-mini. They're both great markets for us. Crude has just been a staple that I trade. I want to trade one index instrument like the NASDAQ, the S&P. I don't particularly like the Dow, and the Russell has too little volume. So for me, it's between the NQ and the E-mini and crude, and that month is NQ crude. So all those trades were 2 contract trades on NQ crude. So listen, have a great evening. Even if you don't come aboard, which I hope you will, I hope it taught you something about what to look for and how to trade and how to modify your trading methodology in a way that's going to change a little bit about what you look for in the market, and really stay in the direction of the trend. Don't call tops and bottoms, long above the 50, short below the 50. Listen, everyone, have a great dinner or a great rest. Best luck to everybody in the market on Monday morning. Take care all. Have a great evening. Bye-bye.